Hi there, it's Bill with Smart Trades, and it's about 3:35 Pacific time on July 1st, and going to do a quick review of the S&P. I'm going to look at the longer term pattern as well as the near term pattern in the S&P Cash, and we'll also take a look at the NASDAQ today. First off, let's look at the longer term pattern, and as some of you may remember, I've actually labeled this as a possible 5-wave sequence up, or it could also be labeled as a triple zigzag. In either case, in the bigger picture, I'm labeling the whole pattern up as either A or 1 up. I prefer that this is an A wave up. At any rate, the previous 4th wave low comes in just above 1029. I rounded that off to 1030. And today we wound up closing at 1027.37, and so possibly we've got a hit on that longer term target at 1030, at least on a closing basis, even though we took it out. I think eventually we're going to actually go through there, and let's take a look at that. Just look at the bigger picture here. A 50% retracement of this entire move comes in around the 945 level, which is also interesting because that's a previous resistance level. And as many of you know, oftentimes previous resistance will become support. And so the combination of a 50% retracement and that previous resistance area makes me take a look at the approximately, let's round it off to about 950 on the S&P. But we're getting ahead of ourselves a little bit. Let's first take a look at the near-term picture off of the recent highs. And off the recent highs, we've got 3 very similar declines. A, B, C, and both A and C are approximately equal in terms of time. A is a little longer in terms of price than C, and then another leg down, which I'm labeling A. So the entire pattern is A, B, C, X, A. This calls for a bounce back up, perhaps back to about the 1075 level, and then another leg down, as I was saying, perhaps to 950. But at any rate, let's take a closer look at these legs, because I do find this rather fascinating, that this first leg down, A, is exactly 8 trading days down. And then you have leg C, again, 8 trading days down. And finally, the current decline, again, 8 trading days down. They're all 100 to 150 point declines, so very similar in magnitude. And if you will, I believe what we have here is a family of fractals. All these declines are related. And so we can expect perhaps another 100, 150 points down, perhaps an 8-day decline after we get this rally. And if we were to bounce, let's say, into this 1075 area, 125 points down, which is sort of the average of these, would put us into that 950 range. But again, we're a little ahead of ourselves here. Let's see how and if we rally off of this low. But I think that most of the Elliott wave world out there is looking this as an impulse decline. I think there's a lot of evidence, if you actually have an open mind and look at the similarities in the declines, that you'll see that the possibility exists that this whole pattern is a double zigzag. It could turn into a triple zigzag for that matter. But the point is that these declines are related both in terms of price and time. And similarly, the rally back up correcting this first decline also fits rather nicely. It's a 50% retracement approximately of the entire decline, which is, just about average for, perhaps a B wave or an X wave, or however you want to label this this rally. And let's, while we're at it, take a look at the NASDAQ Cash. And one thing that the NASDAQ shows us, again, it kind of discounts the possibility that this whole pattern was a diagonal down, in that we've got a series of actually higher lows. On a closing basis, you can count this as an ABC decline, an ABC rally, which by the way comes right back up to this previous gap, and about a 62% retracement of this decline. And then you again have the similar magnitude declines. Now, also of note here, and as I've mentioned before, the S&P does not illustrate gaps very well because there's distortions on the way they calculate the opening. They calculate unchanged issues in the index on the open, and that basically mitigates gaps quite often. At any rate, this is that same congestion area, approximately the 1975 area, basis the S&P, and a filling of that gap on the NASDAQ would take us back to about 1836. And again, let's take a look at the Fibonacci ratios. And that's between the 50 and the 62% retracement level. So certainly an area that potentially we could rally back to. And if you had two similar legs down, let's do a quick calculation on that. Calling for a decline on the NASDAQ, it would take us down perhaps to the 1640 level. If it was a 1.272 expansion, it would take us down to about the 1560 area. So let's take one last look here. Also at the retracement level, basis the NASDAQ, and that 1650 level would be just about a 38% retracement of this entire rally. You know, none of this is a foregone conclusion at this point, but again, when you look at these legs down, the most important thing is, you know, how do they relate? And I believe if you look at the move off the top, you've got a series of relating declines, A, B, C, X, probably A, probably B back up, and we should have at least one more leg down, and then perhaps back off to the races. Anyway, we shall see, and thank you very much for watching. Have a great day. Bye-bye.